So with that, I'd like to introduce our next speaker, and that is Lee Slavutin. And Lee is an entrepreneur, an author, and speaker in the areas of life insurance and financial planning. He is in the Estate Planning Hall of Fame, where he was inducted in 2014, and I could probably just stop there. But he is also a native of Melbourne, Australia, and a medical doctor who came and practiced medicine at Lenox Hill before transitioning into the life insurance industry. Lee.
Thank you very much. Okay, so before I go into this case study, let me tell you a story about another case of a father who has a very, very successful business, and he wants to bring his son in to take over the business, and the son starts working for him, and he says to the son, "What would you like to do?" The son's interested in sales, so he tries sales for about a month or so, comes back to his father and says, "I don't like prospecting. Can you give me something else?" The father says, "Yes, why don't you're good at math, why don't you go into the accounting area and help us in that division?" So he does that for about a month, comes back to his father, "It's boring, I don't like numbers, I don't want to do this." So then the father says, "Okay, let me just, maybe marketing. You know, you could go onto the different social media, help promote us." He tries that for a month, comes back, he's not happy. Father says, "What do you want me to do?" The son says, "Buy me out." Okay, so today is Memorial Day. It also happens to be, this is my wife, it happens to be our wedding anniversary, so a number of... You want me to say that number? Okay, 42. I was wondering whether I should say the number because, then you're saying something about your age or your wife's age, and I'm always careful not to do that. Okay. So let's take a look at my slides. Okay, that's easy to see. Okay, so just a general overview on buying insurance. When you're a client or you are buying a life insurance policy, there should be a rational process that goes behind it, and it should be documented so that the need is clearly identified. I know that sounds very obvious, but sometimes people kind of cut corners and don't go through the proper process. The last point on the slide is very important. When you're buying life insurance or a parachute, you don't look for a bargain. So don't base your choice of the life insurance policy on the price of the policy alone, but rather also look very much at the strength of the company and the Comdex score. The Comdex score is a score that the insurance agent or broker will give you. It's based on the financial ratings from all the different rating agencies like AM Best and Moody's, and it's a composite score. The best score is 100. We will generally deal with companies with a score of 90 or higher. Very important. Why is it important? It's not just about the payment of the claim. It's also about the cost of the policy. If a company gets into trouble, what are they going to do to restore their capital? They're going to charge a higher premium to our customers. So the financial strength of the company impacts the cost of insurance down the road. And we've seen this in the last 10, 15 years with a number of companies increasing the cost of insurance. Okay, so from an insurance perspective, what should we focus on in this case? Clearly, Naomi has a very substantial estate. Most of that estate is illiquid in a business and her home. We also have children in all different kinds of places. Her son is autistic, her daughter has no interest in the business, and the son of her partner is in the business. So we have some issue there in terms of how to use insurance to help with succession. She has a partner, so she wants to protect her partner down the road. And finally, the fourth point in terms of general planning, is there any need for life insurance for the employees of her business? Like, is there a key person in her business that needs to be covered? Should we provide some kind of a deferred compensation program? In Greg's estate plan, I want to just really focus on the last bullet, and that is I don't know how he got to $2 million with his salary, but he's got a $2 million deferred compensation plan. And the question is, how will that be paid out? Will it be paid out as a life annuity, a joint and survivor annuity? If it's paid out as a life annuity, which gives him a higher payout, do we need to get insurance on his life to protect other members of his family? Because remember, a life annuity will terminate when he dies. This is no longer relevant with the caveat that, I've been in this business for many years, and you don't really know until it's signed. And I remember in 1988, now, not all of you were around in 1988, but I remember in 1988, they passed a tax reform that created a new law called a modified endowment contract on life insurance, and they wrote that in literally hours before the bill was finalized in House Ways and Means. So you will not know for sure whether 2901 is in or out until the bill is signed. And so don't relax. Keep your foot on the pedal. Keep watching every day what's happening, because if this comes back, we have a real challenge, especially with life insurance trusts. It's not over. Okay, so now let's talk about Naomi for a little bit. She has an estate of about 26 million. Actually, it's probably more, because the business value that we were given was given a couple of years ago in 2019, and it's probably already much more than $18 million. Based on current law, without any changes, we know that in 2026, the exemption goes down to about $6 million. So if she has a $26 million estate and a $6 million exemption, she has a taxable estate in round numbers of 20 million and a tax in round numbers of 10 or 11 million with federal and New York combined. So that's the tax liability. And that is going to influence the amount of insurance. So how much insurance should she buy if she wants to protect her estate, and she also wants to provide protection for her children, for her autistic son, and she may want to provide some protection for Greg? How much should she buy? There's no hard and fast rule, but if you want to look at the estate tax liability, it's probably at least $10 million of insurance, maybe 10, 15. And I've got on the slide term insurance, because I think with a situation like this, you have to have actually a bit of both. You have to have some term insurance and some permanent. Why term? Because there's some uncertainty about the future of this business. She has 2 children, neither of whom will be in this business. The son is autistic, the daughter has no interest. She has a so-called stepson who is in the business, and she might sell the business. So I don't know where this is going to end up in the next 10, 15, 20 years. If you told me that this was a woman who had 2 children active in the business today, and they want to continue this business in the family without any question, that would change my recommendation dramatically. But here I have a considerable degree of uncertainty. So I want to lock in insurability. I want to get her a large amount of insurance now. We don't know anything about her health, but let's assume she's healthy. I want to get a large amount of insurance now while she's healthy, and because I'm not sure where exactly it'll end up, I'll get some term and some permanent insurance. If we get, say, 10 million of term insurance, remember conversion option. When you're buying term insurance, the most important thing you need to know about that policy is the conversion option. Does it give you the ability to convert that policy for the entire duration of the policy? If I buy a 20-year term, is it going to be convertible for 20 or only for 5? I've seen policies, 20-year term, where the conversion option is only for 5 years. Does the company allow you to convert to any kind of permanent insurance? There are companies today who restrict your ability. I can't name companies. I get into trouble if I do that. But there is a company here in this city that only allows the conversion of some term policies to their most expensive and least efficient whole life policy. It's actually an unacceptable proposition. You really have to go elsewhere and get a new policy. It is so inefficient to convert to that particular product. Now, we have a lot of good reasons to have permanent insurance, that is insurance which goes for the rest of Naomi's life. One is that she has an autistic son. I would probably want about $2 million of whole life or some form of permanent insurance that could ultimately fund a special needs trust for the son. You don't want to get too much because it's not going to be used. You want to get enough that will provide additional benefits to what the government programs are providing, but you don't want to provide insurance that's not going to be used by that son. So about $2 million. You may want protection for Julie and Greg. Now there's, by the way, I just remembered something. It's not on the slide. Both of these people are divorced. One of the greatest things that you can do for a client, a new client, when they come to your office, if they have been divorced, is to check the beneficiary designation of every insurance policy and every retirement account. As Lou said before, when people come to your office, do they have perfect minutes? Have they perfectly adhered to the corporate minutes, to the terms of the note agreement, etc.? The answer is no. Has everyone who got divorced updated their beneficiary? No. How do I know? Because if you read the cases, there's a case that went to the Supreme Court of the United States on a beneficiary designation of a man who died and was divorced before he died, and his ex-wife was the beneficiary. She got the money. All the way to the U.S. Supreme Court, could not defeat that beneficiary designation. This is a very simple thing, but we can do this for our clients when they come in. All of those designations have to be checked. So did Naomi, did she update, she has two policies, did she update those beneficiaries? Okay. The buyout, you may want to do a buyout agreement for Thomas. This goes back again about what Lou said. Do they observe the terms of the agreement? Connolly, it's in my outline, at the end of the outline. Connolly is a case really worth reading if you're in business succession planning. Connolly is a case where they had a buyout agreement and they did what they wanted and they didn't do what the buyout agreement said they should do. They bought $3 million of insurance, and because they did not follow the buy-sell agreement and they were audited when the shareholder died, the $3 million of insurance was added back to the value of the business. That should not happen in buy-sell. When you fund buy-sell with insurance, it should not be adding to the value of the company. It should be offset by the obligation under the buy-sell. They didn't follow the buy-sell, so the IRS won. They added $3 million of insurance to the value of the company. It's a case well worth studying and following to avoid that problem. The ownership of the whole life and guaranteed universal life. Why would you want to buy a policy that has a lot of cash value if you're buying a policy to fund a death benefit for an ultimate estate tax problem? Why would you want to have any cash value? Now, there was a trend years ago for a product called a Guaranteed Universal Life, which doesn't have much cash value, and people were buying a lot of it. The problem with Guaranteed Universal Life, and don't get me wrong, I sell a lot of that product, but the problem with it is that it's a train you cannot get off. You get on a train that's going 100 miles an hour and you say, wait a minute, I want to stop there. Can't get off that train. You buy Guaranteed Universal Life, you cannot get out of that policy without losing basically everything, because in most cases, the Guaranteed Universal Life long-term has no cash value. So if you spend hundreds of thousands of dollars of premium and change your mind, you lose it all. So whole life builds cash value, has an investment component, and gives you the flexibility to change your mind and recover your value. Ownership in this case is actually very elegantly solved, as was described before, when the Beat It now owns the business and all the cash flow, and assuming the cash flow is more than sufficient to serve the debt on the note, we use part of that excess cash flow to fund the insurance premium. And as was stated before by Karen and by Lou, very, very important that the trust does not allow Naomi any incident of ownership in this policy. Very, very critical that the trust provisions never allows Naomi to access the cash value of the policy under her control. That would be a disaster that would bring the policy back into the estate.
And Lee, all the more reason to have that independent trustee in Delaware who would have that power.
Right, right. I did learn a lot about this beat thanks to you. I mean, I've known about it for many years, but I've never really, got into it. So it's very educational. Okay, I want to go through some. How much time do I have, Lou?
You have until 11:35.
What time is it now?
11:18.
Okay. So a few ideas I want to share with you on insurance planning, not necessarily related to this case, but I want to just make you aware of some important ideas. So one of the things which is obviously still topical is we have this 11.7 going up, unless the law changes, going up to over 12 million next year. In a few months, it'll be a $12 million plus exemption for every individual. So therefore, the idea of pre-funding the premiums on an insurance trust now, so that when the exemption goes back down, if it goes back down to 6 million, we don't have to worry about gifts. We can make use of the exemption. Now the question is, if I pre-fund a trust, where do I put the money? I put an example, I put $2 million into a trust. Do I let the money sit in the trust and then pay the premium every year? Let's say it's $100,000 of premium and the trust has got the $2 million. Do I pay that premium every year? Or do I take the $2 million that the trust has and the trustee then writes a check of $2 million to the insurance company? Which one should I do? Any thoughts? A or B? A is the first, B is the second. What? Yes, I like A. I'll tell you why A. I'll tell you why I like A. Because if I put the $2 million into the policy immediately, I have two potential problems. The first problem is I create a modified endowment contract, which means that if, let's say in 5 years' time, the trustee wants to take out $300,000 from the cash value and give it to a beneficiary to buy a house. Nothing wrong with that. But if the policy is a modified endowment contract and I take out $300,000 and there's taxable gain in that policy, I pay income tax. Normally, I don't pay income tax on a loan. But if I take a loan from a MEC, I pay income tax. Number two problem, what if the client buys this policy, let's say $10 million today, and dies in a year? Unexpectedly, we don't know what's going to happen, dies in a year. They gave the $2 million of premium to the insurance company. What does the trust get now a year later? $10 million, that's the death benefit. That means all that extra premium that the insurance company got in year one is basically wasted. If I had kept the $2 million that was going to be allocated to premium in the trust and paid $100,000 of premium for this year, and the client dies next year and dies, then the family gets the $10 million of insurance plus the $1.9 million left in the trust. I lose all of that if I give it to the insurance company. So I would not give it to the insurance company right away. I would keep it in the trust. I know that might create the need for tax reporting, etc., but I think it's outweighed by those benefits. Okay, next thing I want to talk about, because it's particularly relevant for business succession, is split dollar. I can't do split dollar with you today in any detail. It would take hours, but I want to just give you a couple of basic ideas on split dollar. First of all, what is it? It's an arrangement where the company and a trust are sharing the cost of the premium. That's all it means, splitting the cost of the insurance. Number two, why do I use split dollar? What's the reason I engage with this complicated technique? Because in this example, I've got a $100,000 premium. If I didn't do split dollar and I had to pay a $100,000 premium every year, that's $100,000 against my lifetime exemption or the use of crummy powers or both. If I do split dollar, in this example, and this is not an extreme example, only $4,000 out of the 100 is actually a gift. Why? Because the IRS says we have a table that we follow for determining the gift element of insurance under split dollar. I reduced my gift from 100 to 4. So what's the takeaway? Whenever you have a client that has a privately owned business with good cash flow that needs to buy a large amount of insurance, think about split dollar. Client with a privately owned business, good cash flow, needs a large policy, think about split dollar for the gift savings. Please remember this point on the slide. Life insurance premiums are generally not deductible for income tax purposes. General rule, life insurance premiums, now I know there's some accountants in the room, so if you're an accountant and someone says to you, I can get your client a large policy, it's income tax deductible, unless it's one of those three things, a retirement plan contribution, a group term, or an employee bonus, it's not deductible. Any of you who've been around long enough will remember welfare benefit plans, 419 plans. Neonatology is a classical case where they disallowed the premiums. They also imposed a penalty. It's really a very costly procedure for your clients to get involved in anything other than those three things, with very rare exception. Premium finance is another interesting, it was mentioned by the gentleman who spoke to us just a few minutes ago from the bank. Premium finance, why would someone want to borrow money from a bank to pay for premium? I'll tell you why. I did this last year. We have a client, very sophisticated investor. He's worth a lot of money. He's got money mostly in the best hedge funds in the world. And he said to me, my money grows faster than weeds. Not the one you smoke, but the one in the grass. My money grows faster than weeds. He gets 10, 12%, not 1 year, not 2 years, but every year, almost on an average, 10, 12%. So for him to borrow money at 2% from a bank and pay the premium with those borrowed funds and then have available his money to earn 10 is a very attractive proposition. And as long as the policy is structured so that a combination of the cash value and other assets in the trust can repay the loan, we'll be fine. But it needs to be properly structured to make sure you can get out of that loan. Why do you want to get out of that loan? Because at some point the interest will become very expensive. Why will the interest become expensive? Because you're adding to the loan every year. Every year you pay a premium, the loan is growing. And then, of course, we have the possibility, now we know that we have an inflation rate of 6%, it's very likely we're going to see increased interest rates. So for that reason, you need to plan an exit strategy from the premium finance. How much time do I have, Lou?
You have 10 minutes.
Okay, good. Because Lou told me last night that when it gets to the end of my speech, he's going to come here and stand next to me and stop me from talking. So I have to be very careful about my time.
I would not do that to you, Lou.
I'm only kidding. Okay, now, long-term care insurance. It came up in the case study with the mother. She's too old to buy it now, but we have to think about long-term care insurance. And the market today is very different from what it was 10, 15 years ago. Standalone long-term care insurance is off the table. There's very few companies selling it, and it's not worth buying because the premiums keep going up, 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 up. So what is now the most suitable or the best proposition? It's a combination called a hybrid life insurance long-term care policy. Why is it attractive? Because the premium is fully guaranteed. And number two, you can get recovery of between 70 and 100% of your premium from most of these products. So it's worth looking at. It's not going to work for everybody, but it is a much superior choice to the standalone policy. That's just an example. You can look at that later of a man of 49 with that type of a policy. I want to touch on some recent developments. Morissette is a case on intergenerational split dollar, which is kind of an interesting name because it's like this conference, intergenerational. But Morissette, an intergenerational split dollar, is not vanilla split dollar. Please make that distinction. The intergenerational split dollar plan that was attacked in that case is not your bread and butter vanilla split dollar. It's a much more aggressive technique. It was disallowed, and the tax court upheld the disallowance. There is another case pending on Levine. We don't have the answer yet. But make sure you distinguish that from the regular split dollar, which I spoke about before. They're completely different, apples and oranges. Captive insurance companies are now under attack. A recent case of disallowance and penalties, so be careful with captive insurance. The buy-sell I mentioned, Connolly, that was the case where they did not follow the provisions. And then let me just mention now, this is the last thing I think on my slides, 7702. So at the end of last year and the beginning of this year, we had a consolidated budget act passed, and in that act there was a provision that initially not many people noticed, and then suddenly we woke up and realized what was going on. And it's actually an extremely favorable change for life insurance. 7702 is a part of the code that governs the taxation of life insurance, and the fundamental change that was made was really made to save life insurance companies. Life insurance companies since 1984 had to guarantee 4% on whole life insurance. Had to, under the code. They had no choice. That means they were, and remember where we've been the last 5 or 10 years with interest rates, and remember the insurance companies are not investing primarily in equities. Most of the money invested to provide the reserves for a whole life are fixed income. They were not earning 4% on their fixed income. They were earning 2 or 3%. How can they guarantee 4 if they're not earning it? So there was actually, we had one of the product actuaries of one of the largest mutual companies speak to us. He said it was a solvency issue. If they did not make this change, there was a threat to the solvency of these major companies. So they lowered it from 4, and now it can be as low as 2. Now you might say, well, that might be good for the companies, but why is that good for my clients? That's not necessarily good for your clients. You would like to have a 4%, but you can't have the 4% at the expense of the solvency of the company. But the flip side is that when you have a 2% guarantee, and this may sound counterintuitive. If I have to fund an insurance policy of $1 million, this is how the insurance companies figure out their premium. I have to fund $1 million of death benefit. I have to have that $1 million there when the person dies based on life expectancy. If I have a guaranteed rate of 4%, I need X dollars to be paid every year. If I lower the rate to 2%, do I need more X or less than X to fund my policy? Let me repeat it. I got to get to $1 million. I have to pay a premium every year. I have to get to the $1 million, let's say in 30 years when the client's going to die by the actuarial tables. If I calculate my premium based on a 4% guaranteed rate of return, I need a certain amount of money. If I now lower that rate to 2%, do I need more or less each year? Less. More. I need more because I'm only getting 2% on my guaranteed rate. That's how the actuaries calculate. They calculate not on the market, but what's the guarantee? I need to put more money in the policy. So the price of my whole life policy went up. But do you know that the cost went down? You have to distinguish between price and cost. Price is what you pay, cost is your rate of return. If I put more money into the policy and more money is being allocated to cash value for every $1 million of life insurance, that means I'm actually going to get a better return on my money. And if you do the comparison, I know I'm talking quickly, and I know it's not something you're used to dealing with every day, but we've run the numbers, and there's actually an improvement of about 40 basis points on the rate of return on cash value on the new products. They are much more attractive in terms of their rate of return on cash. That is a very positive result from 7702. I want to just summarize to you, I've made a whole lot of points. I want to just, how much time do I have?
You have 3 minutes.
Great, okay. So here, I want you to write these things down if you can. I mean, I'm going to say it fairly quickly, but try to write these down. These are some really important takeaways for you, for your clients. Number 1, remember the Comdex score when you're buying insurance. You want to get a financially strong company. Number 2, remember to check the beneficiary designations on your clients. Divorced or not divorced, doesn't matter. Every client should have the beneficiary designation on the insurance and retirement accounts checked. Number 3, when you buy term insurance, remember the conversion option. Always make sure you have a good conversion option. Number 4, the reason you buy whole life cash value is flexibility. You don't want to get on the train and not be able to get off the train. Number 5, when you're making a large gift to an insurance trust, keep the money in the trust. Don't give it all to the insurance company. Number 6, when you have a privately owned business with good cash flow and you want to buy insurance, think about split dollar. Number 7, remember there is no deduction for life insurance premiums paid by the business unless it meets one of the 3 examples in the slide. Number 8, if you're buying long-term care insurance, think about the hybrid product with a guaranteed premium. Number 9, on buy-sell, look at the Connolly case. Don't get into the trap that they got into where the insurance was added to the value of the business. And number 10, 7702 has had a very positive impact on insurance. Thank you very much, everybody.
Thank you, Lee. That was worth the price of admission. I have a couple questions. On the Beat It Trust, now that you've looked at it for the first time, what do you think? And do you think that's a place where you could engage in something like a split dollar inside of the Beat It with the business value? Would that be adequate collateral for a lender?
So the first part of the question is, I like the Beat It Trust because it's got a built-in mechanism to pay premiums. It's wonderful. You know, you've got the cash flow from the business, which you can use to pay premiums. Now, you have to explain to me what you mean with, how are you going to do split dollar here? Rather
than using the cash flow, borrowing the money inside of the Beat It to pay the life insurance premium.
Borrowing the money from?
From a lender.
Oh, yes, you could do that. I mean, why would you want to do that, though, if you've got the cash flow there?
If you want to keep, like you said, the person that gets 12%
if she
wants to keep the business growth, she has an accelerating growth rate inside of her business.
So the Beat It goes out to a bank.
So it's really a collateral question. Would that business be collateral that would suffice to a lender?
That's for the banker to answer. I think you have to have enough cash in the trust to cover the spread between the cash value of the policy and the loan. So if the loan in 3 years is $3 million and the cash value is 2.2, you need to have $800,000 of cash in the trust to cover the spread.
Okay, so that wouldn't allow her to then reinvest the money in the business. She'd
You'd have to have a certain amount there as
reserves.
Collateral.
Interesting. Okay. Yeah. Any other questions for Lee while we have him? Yes.
You didn't comment at all on private placement life insurance, sort of sheltering assets.
So the question is on PPLI, private placement.
So it's a very, private placement life insurance, very, very interesting subject, very interesting product. It's really for the very wealthy client. The minimum commitment is usually millions of dollars, $2, $3 million over a 5-year period, sometimes more. So if a client wants to buy a policy and spend $50,000, they're not going to buy private placement life insurance. If they want to invest in a private placement, $1, $2, $3, $4 million over a period of 5 years because of the investment value of the insurance, they are the right client. We're usually talking about someone whose net worth is upwards of $30, $40, $50 million, typically to do a private placement. Now, why is private placement so attractive as an investment as opposed to regular life insurance? For 2 reasons. Number 1, the commission on a private placement policy is much lower than a regular policy. Typical commission on a private placement is 1% of premium, whereas on an ordinary off-the-shelf life insurance, the premium commission might be 30, 40% of the first-year premium, or might be higher. But on a private placement, it's only 1% typically, maybe less. Second reason private placement is attractive is the nature of the underlying investment. You have the ability in a private placement to do a whole bunch of investments you can't do with ordinary insurance. You can actually have hedge funds on the menu, really good hedge funds on the menu to invest in with a private placement. Some very wealthy families even say, you know what, we want to put in $50 million in a private placement and we want to structure our own sub-account. And they have their own advisors at JP Morgan or whomever they are, and they set up a special sub-account which is approved by the insurance company for investment, and they can now invest in that particular account. So private placement is for the very wealthy, and it's a very attractive investment opportunity. The basic rationale is that the cost of the policy is about 1% annually, and that's going to be compared to the tax savings. If I was investing and getting 10% and losing 4% in tax, and it's costing me 1%, that's a good deal.
That's the most succinct explanation of private placement life insurance I've ever heard. Thank you. One more question, then we're going to get to the next speaker. We will have time again at the end, so write your questions down. We'll get back to them.
I'll try to make this one quick, but it might not be pertinent to this case, but lowering from the 4% to the 2% on the actuaries, have they also raised the MEC limits proportion to that if we're trying to build tax-efficient retirement income for a particular client?
Yeah, the question is on the 7702, when we lowered the guaranteed interest rate from 4% to 2%, has that increased the MEC limit? Remember, the MEC is that policy where you lose the normal tax benefits of taking out tax-free loans. There's a thing called the MEC limit. How much money can I put into an insurance policy every year without causing it to be a MEC? And it's on the illustration. You'll see it on every page. So if the rate was calculated at 4%, and let's say the MEC limit on $1 million policy is $50,000 at 4%, at 2% it might be $75,000. So the MEC limit will go up, and that will allow you to put more money into the policy, tax deferred, without having a problem. So yes, that's another benefit.
Excellent question. And that's the 7702 changes are major in that regard. So they've opened up doors for accumulation inside of life insurance that didn't exist before. All right. I want to remind everyone, complete your surveys as we go. And again, give us your ideas for next year. If you would just keep up with that, and we're going to collect them at the end.